Okay, let's just dive right in. Think about this. You've got some investments, maybe a particular stock that's, really grown over the years. And you look at it and think, wow, this would be a great way to help out my daughter, or maybe a grandchild, or even a good friend. So you decide, I'll give them some of these shares.
Seems simple, right? Just a nice, generous thing to do. Sign them over.
Yes.
But hold on a sec. That simple idea runs smack into the often complex world of U.S. tax law, because even after you've made the gift, the IRS is definitely still paying attention. They're watching what happens next.
That's such a critical point where people get tripped up. The act of giving the stock, that brings up one set of questions, gift tax reporting maybe. But the real tax hit, the one that often blindsides the person receiving the gift, that comes later, when they eventually sell those shares you gave them. Understanding both pieces, the giving part and the selling part, especially that future impact, that's really the key. Exactly. So that's what this deep dive's all about. We're peeling back the layers on gifting shares of stock, specifically in the U.S. We're not just talking about, feeling good about giving. We're getting into the nitty-gritty tax stuff. We'll break down the federal gift tax rules, those important exclusions and exemptions. But honestly, the heart of it, and maybe the most important thing for you listening, is this whole idea of basis. Specifically, how the basis of stock changes, or crucially, doesn't change when it's a gift, and what that means for the recipient when they eventually sell.
Right. And to figure this out, we've gone to the official sources. We're looking at IRS publications, the instructions for Form 709, that's the gift tax return form, plus insights from financial advisors and tax pros who deal with this stuff every day. It's definitely dense material, but our mission here is to cut through the jargon, pull out the essential bits you need to know about gifting stock.
Yeah, we want you to walk away from this feeling like you really get it, not just the process, but the surprising facts, the potential traps, so you understand the true cost, the consequences, not just for the person giving, but for the receiver too. So let's start super basic. When we say gifted stock, what are we actually talking about?
Well, at its core, it's just stock shares transferred from one person or entity to another without getting paid back. It's a voluntary ownership transfer, done out of generosity.
So not a sale, just giving it away.
Precisely. And the sources make it clear. The federal gift tax is broad. It covers basically any transfer of property as a gift. Doesn't matter if it's real estate, stuff you can touch, or intangible things like stocks, bonds, even cash, directly or indirectly.
Indirectly. You mean like if I pay someone's credit card bill, is that a gift?
That could certainly count as an indirect gift, yeah. And the source material points out something else interesting, too. Even if you structure something as a sale, but you get way less back than the thing is worth, that difference can be treated as a gift, especially if it's not a standard business deal. It shows the IRS is looking at the substance, Was value essentially given away for free?
Makes sense. They don't want people just calling a gift a sale to get around the rules. And I noticed the sources specifically mention digital assets now, too.
They do. It's explicit in the Form 709 instructions, transferring digital assets. Subject to gift tax. That means cryptocurrencies, stablecoins, NFTs, basically any digital value on one of those secure ledgers. There's even a direct question now in the Form 709, line 21, I think, asking if you transferred any digital assets. Everyone filing has to answer it.
Okay, so gifting stock clearly falls under these gift rules. But why do people do it? What's the motivation besides just being generous?
Well, simple altruism is a big one, right? Just wanting to help families share wealth. Gifting assets, especially ones that have gone up in value or might grow a lot more, can be a really substantial way to give someone a leg up.
And there can be some tax strategy involved too, can't there? Thinking ahead.
Absolutely. A potential advantage sometimes, compared to you selling the stock yourself and then giving the cash, it relates to taxes later on. If the person you give the stock to is in a lower income tax bracket than you are, well, when they eventually sell that stock, they might pay less in capital gains tax than you would have paid if you'd sold it first.
Ah, okay. So passing the future tax event to someone potentially in a lower bracket, that's a possible benefit.
It's definitely a consideration. Not always the case, depends on the numbers, but yeah.
That makes sense as a motivator.
Yeah.
Okay, let's shift to the giver's side now.
Yeah.
The U.S. gift tax itself.
Right. The basic idea is simple. Gratuitous transfers gifts are subject to this federal tax, and it's separate from any other tax, like income tax, that might apply.
Okay, but surely not every single little gift needs to be reported, right? The sources mention some things that aren't considered gifts for the purpose of filing that Form 709.
Correct. There are specific exclusions. For example, transfers to political organizations generally don't count. Same for certain tax-exempt groups like civic leagues or business leagues. if it's for the organization's use.
And then there are those two really important ones for helping individuals, education and medical payments. But the rules there are super specific.
Very specific. For the educational exclusion, you have to pay the money directly to the school, a qualifying school, domestic or foreign. And critically, it only covers tuition. Not room and board, not books, not fees, just tuition.
So if I want to help my nephew with college, I send a check straight to the university's tuition office, not to him.
Exactly. If you give him the money for books, that's a gift to him. And the medical exclusion is similar. You pay directly to the person or place providing a medical care, doctor, hospital, whatever. It has to be for qualified medical expenses meeting the IRS definition. And the sources specifically say it doesn't apply if the person you paid for gets reimbursed by their insurance later. That reimbursed amount then becomes a gift to them.
Wow. Okay, so direct payment is absolutely key for both of those exclusions. They're powerful, but you got to follow the rules. What about gifts between spouses?
Well, for spouses who are U.S. citizens, there's generally an unlimited marital deduction, meaning you can give as much as you want to your citizen spouse without worrying about federal gift tax. There are some complex exceptions for things called terminable interests, and the rules are different if your spouse is not a U.S. citizen. But for most gifts between citizen spouses, no gift tax.
Unlimited for citizen spouses, got it. So for gifts to anyone else, kids, friends, grandkids, that's where the annual exclusion and the lifetime exemption kick in. These are the numbers people hear about most often.
Absolutely. The annual gift tax exclusion is your friend here. It's the amount you can give to each individual person every single year without having to report it on Form 709 and without it eating into your big lifetime limit.
And this amount adjusts for inflation sometimes, right? What is it currently?
Good point. For 2024, that annual exclusion is $18,000 per person. And looking ahead, for 2025, it's bumping up slightly to $19,000 per person.
Okay, so in 2024, I could give $18,000 to my son, $18,000 to my daughter, $18,000 to my best friend. All separate people. And none of that requires filing a gift tax return.
That's exactly right. As long as each gift to each person is $18,000 or less, it's per recipient. And married couples, they can effectively double that amount per person using something called gift splitting.
Gift splitting, how does that work? Is it complicated?
It's an election you make. If you're married, you can choose to treat a gift made by just one of you as if it came half from each of you. So you get to use both of your annual exclusions for that one gift recipient. For example, in 2024, a couple could give $36,000 total, $18K plus $18K, to their grandchild without touching their lifetime limits. But, and this is important, you do have to file Form 709 to elect gift splitting, even if the split amount per spouse is under the annual limit. The non-gifting spouse also has to formally consent on the return.
Okay, so gift splitting requires filing, but it lets couples give more per person annually without consequence. So the annual exclusion handles a lot of gifting. What about that lifetime limit you mentioned?
Right, the lifetime gift tax exemption. Think of it as a big pot of money representing the total value of gifts you can give over and above those annual exclusion amounts during your entire life before you actually have to pay any federal gift tax. It's cumulative.
And that number is significantly larger.
Oh, yeah. Much larger. For 2024, the lifetime exemption is $13.61 million per individual. For 2025, it's scheduled to be $13.99 million per individual. So again, a married couple, if they plan it right, effectively has double that combined amount available over their lifetimes.
13.61 million. Wow. I mean, most people aren't going to give away that much money above the annual limits in their lifetime.
That's true for a lot of folks.
Yeah.
But for people with substantial wealth, managing this lifetime exemption is a huge part of estate planning. And this brings us to something really, really critical that the sources are highlighting right now. Their sense of urgency, because this super high lifetime exemption, it's set to expire.
Ah, right. The 2026 sunset. I've heard about that.
Exactly. Under the current law, the Tax Cuts and Jobs Act provision that boosted these exemption amounts, it ends after December 31st, 2025. So starting January 1st, 2026, the lifetime gift and estate tax exemption is scheduled to drop back down to roughly half of what it is now adjusted for inflation. We're talking maybe around $7 million per person, maybe even a bit less.
Okay, let me wrap my head around that. So if I gave away, say, $10 million in appreciated stock in 2025, that would use up a chunk of my $13.99 million exemption, but I wouldn't owe tax. But if I wait and make that same $10 million gift in 2026, and the exemption is only, say, $7 million, then $3 million of that gift would suddenly be taxable.
Potentially, yes. You'd have exceeded the lower lifetime limit, and that excess $3 million could trigger actual gift tax payment. This looming deadline is why financial advisors are talking to clients with larger estates about potentially making significant gifts before the end of 2025. To lock in the use of today's higher exemption amount, it's a classic example of how tax law changes can create these planning windows.
That's a really important heads up for people thinking about large transfers. Okay, what about gifts to a spouse who isn't a U.S. citizen? You mentioned that's different.
Right. If your spouse is not a U.S. citizen, the unlimited marital deduction doesn't apply in the same way for gifts. There is an annual exclusion for gifts to a non-citizen spouse, but it's much higher than the regular annual exclusion. For 2024, it's $185,000. Gifts above that $185,000 threshold to a non-citizen spouse generally need to be reported on Form 709. If your total gifts are below that and meet certain other criteria, you might not need to report them, but exceeding it triggers reporting for all gifts to that spouse that year.
Okay, different rules for non-citizen spouses. Good to know. So we've covered the gift tax side for the giver who pays when, the limits. Now, let's pivot to what might be even more crucial for many families, basis. This seems to be where the real long-term impact lies.
It really is. Basis is fundamental for taxes, but it's often misunderstood, especially in the context of gifts, and it dramatically affects the recipient.
So let's just unpack basis. What is it in simple terms?
Basis is essentially your investment in an asset for tax purposes. It's the number you start with to calculate your profit or loss when you eventually sell it. Usually, if you buy stock, your basis is your cost, what you paid for it, plus maybe some related costs like commissions. Keeping good records of this cost is vital.
Makes sense. Buy stock for $1,000, sell for $3,000. My gain is $2,000 because my basis was $1,000. That $2,000 is what I pay tax on.
Exactly. Now, here's the absolute key distinction for gifted property. It's called the carryover basis rule. When you receive stock or other property as a gift, your basis in that property is generally the same as the donor's adjusted basis right before they gave it to you.
Wait, so it's not the value of the stock on the day I received the gift?
Generally, no. It carries over from the donor. Let's use the example from the source material. Say your aunt bought stock years ago for $7,000. It's done really well. She gives it to you today, and it's now worth $12,000. Your basis in that stock isn't $12,000. It's her original $7,000 cost basis.
Whoa. Okay, so that $5,000 of appreciation that happened while she owned it, $12,000 value minus $7,000 basis, that potential gain is now my problem, tax-wise, if I sell it.
That's the carryover basis rule in action. You inherit her low basis. Now, there is a wrinkle to this if the stock has actually lost value before being gifted.
A special rule for losses.
Yeah, it's a bit weird, designed to prevent people from gifting losses. Here's how it works. If on the day of the gift, the fair market value, FMV, of the stock is less than the donor's basis, then things get tricky when the recipient sells. For calculating a loss on the sale, the recipient has to use the lower FMV on the date of the gift as their basis.
Okay, let's walk through that. Say Dad bought stock for $10,000. Bad luck, it drops to $6,000. He gifts it to me when it's worth $6,000. So his basis was $10K. The FMV at gifting was $6K. Now I sell it later.
Right. If you sell it for, say, $7,000, that's more than the $6,000 FMV at the time of the gift, but less than Dad's original $10,000 basis. In that specific situation, selling between the FMV and the donor's basis, you actually have neither a gain nor a loss for tax purposes.
No gain, no loss. That's odd.
It is. The tax code basically says, in that narrow band, nothing happened tax-wise. Now, what if you sell it for less than the gift date FMV? So you sell it for $5,000.
Okay, selling below the $6,000 value it had when I got it.
Now, because you're calculating a loss, you must use the lower FMV from the gift date as your basis. So your basis for loss purposes is $6,000. You sold for $5,000. Your deductible loss is $1,000. $6K basis, $5,000 price.
Even though Dad's original basis was $10,000, if I could use that, my loss would look like $5,000.
Exactly. This rule prevents Dad from transferring that $4,000 built-in loss, 10K basis, 6K FMV, to you through the gift. You can only claim a loss based on the value decline after you received it.
Got it. That loss rule is definitely tricky, aims to stop tax games. But the main rule, that carryover basis for appreciated stock, that has huge implications for the recipient. It locks in the donor's low cost.
And this is where the sources draw a really stark contrast with what happens when you inherit property instead of receiving it as a gift.
The famous step up in basis.
Yeah.
That's totally different. Yeah.
Completely different ballgame, and usually much better for the recipient. When you inherit property from someone who's passed away, your basis is generally stepped up or sometimes stepped down to the fair market value, FMV, of that property on the date of the person's death.
So let's use that house example from the source. Mom bought a house for $100,000 decades ago. When she passes away, it's appraised at $300,000.
If you inherit that house, your basis isn't mom's old $100,000 cost. Your basis becomes $300,000, the value at her death. If you turn around and sell it immediately for $300,000, what's your taxable gain?
Zero. $300K sale, $300K stepped-up basis.
Yeah.
The $200,000 appreciation that happened during mom's lifetime is just wiped away for capital gains tax purposes for me, the inheritor.
Exactly. Wiped away. Now compare that to gifting. If mom had gifted you that same house right before she died, when it was worth $300K, but her basis was still $100.
Then my basis would be your $100 because of carryover basis. And if I sold it for $300K, I'd have a $200,000 taxable gain.
Precisely. The tax difference for the recipient is enormous. Gifting appreciated assets means passing along that built-in capital gain. Inheriting appreciated assets, thanks to the step-up, often eliminates it. This difference carryover basis for gifts versus step-up basis for inheritances is probably the single most important factor affecting the recipient's future tax liability.
It really changes the calculation on whether it's better to gift now or let someone inherit later, at least from the recipient's tax perspective. The sources mention one small exception to the step-up rule, though. Something about gifting and getting it back quickly.
Ah, yes, the anti-abuse rule. If you gift appreciated property to someone and that person dies within 1 year of receiving the gift, and you inherit that same property back from them, you don't get the step up. Your basis will generally be the decedent's adjusted basis right before they died, which would likely be the low basis that carried over from your original gift.
Okay, so you can't just gift assets to someone frail, hoping to get them back immediately with a higher basis. Prevents that loophole.
Right, but the main principle holds. Gifting usually means carryover basis, inheritance usually means stepped-up basis, and that flows directly into the recipient's capital gains tax situation when they sell.
Let's talk about that. So the person who got the gifted stock decides to sell it. They owe capital gains tax, right?
They do. They're responsible for the tax on any gain realized from selling that stock.
And the gain is the sale price minus their basis, which we just established is usually the donor's original low basis.
Correct. Back to the 7K over basis stock gifted when worth 12K. If the recipient later sells it for, say, $15,000, their gain is $15,000 sale price minus $7,000 their carryover basis. That's an $8,000 taxable gain for them.
Okay, an $8,000 gain. Now, is that taxed at the high short-term rates or the lower long-term rates? That depends on how long the stock was held, doesn't it?
It does. And here's actually some good news for the recipient. The holding period of the person who gifted the stock gets added or tacked on to the recipient's holding period.
Oh, really?
Yeah.
So if my aunt held that stock for 10 years before gifting it to me and I sell it the next day, my holding period is considered 10 years and 1 day.
That's exactly how it works, which means if the donor held the stock for more than 1 year, the threshold for long-term capital gains, any gain the recipient realizes will automatically qualify for the lower long-term capital gains tax rates.
It's a pretty nice benefit. It means even though I inherit the low basis, the resulting gain gets taxed at the preferential long-term rate, assuming the donor held it long enough. That definitely helps soften the blow of the carryover basis.
It does. It ensures the appreciation that happened over the donor's long holding period isn't suddenly hit with high short-term rates just because the recipient sells quickly. Now, the sources did mention one other potential complexity here, especially if you're gifting to a minor child: the kiddie tax.
Like kiddie tax.
Yeah.
Yeah, that sounds vaguely ominous. What's the deal there?
Well, the idea of gifting appreciated stock to your child might seem smart, right? They probably have little or no other income, so they'd be in a very low tax bracket, maybe even zero. But the kiddie tax rules are designed to limit that strategy. For children under a certain age, generally up to age 18 or 24 if a full-time student, their unearned income, like dividends or capital gains from selling stock above a certain threshold, gets taxed at the parent's marginal tax rate, not the child's low rate. For 2024, that threshold for unearned income is $2,600. Anything above that could be taxed at mom and dad's higher rate.
Ah, okay. So you can't just shift huge capital gains to your kids to pay zero tax. The kiddie tax can claw a chunk of that back to your own tax rate. Something to definitely be aware of if gift to minors.
Absolutely. It adds another layer to the planning. Okay, so let's shift to the practical stuff. How does this gifting actually happen, and what's the paperwork?
How do you physically transfer stock as a gift?
Usually, if the stock is in a brokerage account, it's pretty straightforward. The donor tells their broker, transfer X shares of Y stock from my account to my nephew's account. It's typically an electronic transfer between brokerage accounts. The sources mention POD, transfer on death, but that's different. That happens automatically after death based on a prior designation, not a lifetime gift. For lifetime gifts, it's usually just instructing your broker.
Okay, broker's transfer. And the main IRS form we keep mentioning is Form 709, the gift tax return.
Correct. That's the key form for reporting taxable gifts to the IRS. And remember, it's an annual return.
When's it due? With my income tax return.
Usually the same deadline, yes. It's generally due by April 15th of the year after the year you made the gift. Same deadline as individual income tax returns, including extensions if you file for one.
But I don't need to file one just because I gave someone a birthday present, right? When do I absolutely have to file Form 709?
Good question. You must file Form 709 if, during the calendar year, you made gifts to any one person, other than your U.S. citizen spouse, that exceeded the annual exclusion amount. So more than $18,000 to one person in 2024 means you have to file. You also must file if you made any gift of what's called a future interest, no matter how small the value.
A future interest, what's that mean?
It's basically a gift where the recipient doesn't get the immediate right to possess or enjoy the property. Think certain types of trust interests where payouts are delayed. Because these don't qualify for the annual exclusion, any gift of a future interest triggers the filing requirement.
Okay. And if I do have to file Form 709 because I gave someone more than the annual exclusion, do I need to list all my gifts on it, even small ones? How about charity?
If you're required to file for non-charitable gifts, yes, you generally have to report all gifts you made during the year, including gifts to charities, even though they're usually deductible. And remember, if you elected gift splitting with your spouse, you must file Form 709 to make that election official, even if the split amount per spouse was below the $18,000 limit.
Right. Gift splitting always requires filing. What info does the IRS want on this form about the stock I gifted?
They need specifics. Your info, the recipient's info, name, address, relationship, for the stock itself. The date of the gift, a clear description, like 100 shares of XYZ Corp common stock, maybe the COSIP number if you have it. And critically, the fair market value, FMV, on the exact date the gift was completed. For publicly traded stock, that FMV is usually the average of the high and low selling prices on the gift date. There are rules for weekends or days with no trades. For stock that isn't publicly traded, valuation gets much more complex and often requires a qualified appraisal.
So nailing down that FMV on the gift date is crucial for the form. What if I file it and then realize I made a mistake? Can I fix it?
Yes, you can file an amended Form 709. You just file a new Form 709, check the box indicating it's amended, attach a statement explaining the changes, and include a copy of the original return you filed.
And I assume there are penalties if you don't file when you should, or if you file late, or if you get the values wrong.
Oh, absolutely. The IRS can hit you with penalties for late filing, late payment of any tax due, unless you have reasonable cause, and accuracy-related penalties, especially for undervaluing the gifts. Those valuation understatement penalties can be pretty steep, particularly if the undervaluation is considered substantial or gross.
Makes sense. Undervaluing the gift would directly lower the amount applied against your lifetime exemption or the tax potentially due, so the IRS watches that closely.
But they definitely do. Accuracy, especially with valuation, is really important.
Okay, that covers the basics of gifting and reporting. Are there other, maybe more complex concepts or pitfalls people should know about when they're thinking about this?
Well, the form itself mentions the generation skipping transfer, or GST, tax. This is a whole separate tax system that runs alongside the gift and estate tax. It can apply to transfers made directly or indirectly to a skip person.
A skip person?
Yeah.
That sounds like someone skipping a generation, like a grandchild.
Generally, yes. It's typically someone 2 or more generations younger than the donor grandchildren, great-grandchildren. Or it could be certain trusts set up for their benefit. The GST tax is incredibly complex. Form 709 is used to report certain lifetime transfers to skip persons and to allocate your lifetime GST exemption, which is the same large amount as the gift tax exemption currently. Making sure you handle GST allocation correctly or elect out of automatic allocation if needed is critical and definitely requires expert advice if you're gifting to younger generations or using trusts.
Okay, so gifts to grandkids or in trust structures. Red flag to get professional GST tax advice.
Absolutely. Another concept mentioned is a qualified disclaimer.
What's that for?
It's basically a formal way for someone receiving a gift or inheritance to say no thank you. If done correctly, it has to be in writing within a specific time frame, usually 9 months. And before accepting any benefit, the law treats it as if the person never received the gift in the first place. This can be useful for redirecting assets without the disclaiming person being treated as making a second gift themselves.
Interesting. So if I inherit stock I don't want or need, I can disclaim it, and it might pass to my kids, for example, without me triggering gift tax rules.
Potentially, yes, depending on the will or state law. The sources also briefly mention Section 2701 elections. These are super technical rules about valuing interests in family businesses or trusts when transferred to family members. Definitely requires specialized advice.
Yeah, sounds like we're getting into highly specialized territory there. One of the sources, Comerica, also pointed out some common mistakes people make in this whole wealth transfer area. They seem relevant here.
They really are. One of the biggest. Simply waiting too long to start planning. Especially with that potential 2026 cliff for the lifetime exemption, procrastination can be really costly. Finding good advisors, thinking through strategies, implementing them, it all takes time.
So that urgency we talked about is real. Don't wait until December 2025 to start thinking about large gifts.
Exactly. Another common mistake is not correctly handling the complex stuff. Things like allocating that GST exemption properly, making sure gift splitting is documented correctly with spousal consent, ensuring all necessary disclosures are made on Form 709. Trying to DIY these complex transfers is asking for trouble.
It really sounds like getting expert legal and tax help is non-negotiable for anything beyond straightforward annual gifts.
It truly is. And a third major pitfall they highlighted ties directly back to our basis discussion, not fully considering the future tax impact on the recipient or the potential burden of the gift. Remember, gifting that highly appreciated stock might feel good and get it out of your estate, but the recipient gets stuck with your low basis.
That carryover basis, leading to potentially big capital gains tax for them later, unlike the step-up they'd get from inheriting.
Precisely. You have to weigh that trade-off. Is it better for you to avoid estate tax on future growth, or better for them to avoid capital gains tax via a step-up? There's no single right answer. It depends on the whole picture. And also, think about the practical side for the beneficiary. Can they actually handle the asset? Gifting, say, a rental property sounds generous, but can they manage it? Pay the taxes, the upkeep. Sometimes gifting cash or assets that generate cash flow makes more sense.
Don't just give the gift. Think about whether the recipient can actually afford to keep the gift.
Good point.
A very practical one. And the last mistake mentioned is crucial for the donor. Gifting away assets or income streams that you might actually need yourself later on. Saving on transfer taxes is great, but not if it jeopardizes your own financial security in retirement. You need to make sure you retain enough for your own future needs.
That's fundamental. Secure your own oxygen mask first before assisting others. Well put. Responsible planning is about balancing helping others with ensuring your own well-being.
Wow. Okay, we have covered a lot of ground today. We started by defining gifted stock, why it falls under tax rules. We dug into the federal gift tax, the annual exclusion, $18K for 2024, $19K for 2025, that huge lifetime exemption, $13.61 for 2024, $13.99 for 2025, and importantly, the potential cut coming in 2026, plus those specific exclusions for education, medical, and spouses.
And then, critically, we spent a good chunk of time unpacking basis. The carryover basis rule for gifts, where the recipient takes the donor's basis, and how that differs dramatically from the step-up in basis for inherited property, which usually wipes out pre-death appreciation for tax purposes. That difference is huge.
Huge. And we saw how that impacts the recipient when they sell. They pay capital gains tax based on that carryover basis. But the good news is their holding period includes the donors, helping them qualify for lower long-term rates. We also flagged the kiddie tax as a potential issue for gifts to minors.
Right. And finally, we walk through the process. Transferring stock, reporting gifts on Form 709 when you need to file, the deadlines, the information required, valuation issues, penalties. And we touched on those complex cousins, GST tax, disclaimers, and highlighted some key planning mistakes to avoid.
So if there's one core lesson from all this, it really seems to be that gifting stock isn't just a simple transfer. It's loaded with tax implications.
Right.
For the giver, there's the reporting, using up that lifetime exemption. But maybe even more significantly for the receiver, there's that carryover basis, which dictates the future capital gains tax. That fundamental difference, carryover basis versus step-up basis, seems like the linchpin for how much tax the next generation ultimately pays.
It really shifts the future tax liability onto the recipient, and they absolutely need to understand that built-in gain they're receiving.
Exactly. Which leads to the final thought for you, the listener. Given everything we've talked about, especially that potential halving of the lifetime exemption in 2026, and the profound difference in tax outcomes between gifting now versus inheriting later, what does this suggest for your situation? Does understanding carryover versus step-up make you reconsider how or when you might pass appreciated assets like stock? It certainly makes you think. Waiting beyond 2025 could mean playing under a completely different and potentially much more costly set of tax rules.
Definitely food for thought and a strong case for proactive planning.
Indeed. Well, thank you for joining us for this deep dive into the complexities of gifting stock. We really hope this conversation gave you some valuable insights.
And please remember, this is complex stuff. We strongly encourage you to talk with your own qualified tax advisor and legal counsel about your specific situation and goals before making any decisions. Until next time.